You might dream of owning a luxury home, a sprawling estate, or a penthouse with panoramic views. The allure is undeniable: high-end finishes, exclusive neighborhoods, and the perceived prestige of an expensive address. Well, if I told you that, for many, luxury real estate is one of the worst investments you can make, that's right. The dark truth about luxury property is that its high price often masks a host of financial pitfalls that can severely hinder your long-term wealth building, rather than accelerate it. In fact, for purely financial returns, a luxury home can often be outperformed by far more modest strategic investments. If you're thinking about buying or investing in high-end real estate, or if you simply want to understand the true dynamics of the property market, you need to hear this before you make a decision that could tie up your capital for decades. The problem with luxury real estate often begins with emotion. We're drawn to beautiful spaces, the sense of status, and the idea of living the dream. This emotional pull can make even savvy individuals overlook fundamental real estate principles. For a first-time homebuyer looking to stretch into a nicer neighborhood, or an experienced investor eyeing a trophy asset, the mistake is the same: equating high price with high value or guaranteed appreciation. Many overlook the hidden costs: dramatically higher property taxes, insurance premiums, and maintenance expenses for specialized features like smart home systems, infinity pools, or elaborate landscaping. They assume that because it's expensive, it must be a good investment. But luxury markets often have a limited buyer pool, making them less liquid. When it's time to sell, you might find yourself waiting far longer and potentially taking a lower price than you would for a more mainstream property. This isn't just about personal enjoyment, it's about making a sound financial decision that impacts your entire wealth trajectory. At the heart of the dark truth lies the concept of market depth and liquidity. Imagine a pyramid. At the very bottom, you have starter homes and mid-range properties, a vast market with many buyers and sellers. This high demand ensures relatively consistent appreciation and quicker sale. As you move up the pyramid into the luxury segment, the pool of potential buyers shrinks dramatically. This limited buyer pool means luxury properties often take longer to sell. This lack of liquidity is a major financial risk. For investors, this can tie up capital that could be generating returns elsewhere. For homeowners, it can make relocating or upsizing a nightmare if you can't sell your current luxury property for its perceived value within a reasonable time frame. Experienced real estate investors understand that profitability is often found in properties that appeal to the broadest segment of the market, not the narrowest. They focus on fundamentals like consistent demand, rentability, and the ability to exit the investment easily, rather than just the wow factor. So, how do smart investors and homebuyers avoid the luxury trap? We use what we call the fundamentals Over Flair framework. It's about prioritizing objective metrics over subjective aesthetics. First, analyze the demand segment too. Who is the target buyer or renter for this property? Is it a broad segment or a highly niche, wealthy few? The broader the demand, the more stable your investment. Second, assess holding costs versus potential returns. Calculate not just the mortgage, but taxes, insurance, maintenance, and potential HOA fees. For an investment, compare these directly to realistic rental income and appreciation forecast. Luxury properties have disproportionately higher holding costs relative to their potential returns compared to mid-range properties. Third, evaluate exit strategy and liquidity. How quickly could you sell this property if needed? Research historical market data for similar luxury homes in the area. Did they sit on the market for months or years? This is critical for managing risk. Fourth, the opportunity cost. What else could you do with that capital? Could you invest in 2 or 3 cash-flowing, high-demand properties instead of one luxury asset? This framework ensures you're making a strategic decision not an emotional one. Let's look at a realistic example. Sarah, a high-earning professional, wants to build wealth through real estate. She has substantial capital. Option A. Sarah buys a $2 million luxury condo with stunning views. Monthly expenses, mortgage, taxes, HOA, premium insurance are $10,000. It appreciates at 2% annually, typical for many high-end limited-demand properties, and it's expensive to rent out, barely covering costs. Option B. Sarah instead buys two well-located, mid-range family homes, each for $700,000, and a smaller condo for $300,000, totaling $1.70 million. The remaining $300,000 acts as a cash reserve for renovations or future opportunities. Each property generates positive cash flow after expenses, and they appreciate at a more robust 5% annually due to consistent demand. After 10 years, Option A's condo is worth $2.44 million with minimal cash flow. Option B's diversified portfolio is worth approximately $2.75 million day plus one. She's accumulated significant cash flow from rentals, built more equity across multiple assets, and enjoys greater liquidity. The dark truth is that the lower-priced, strategically chosen properties often outperform the single, glamorous luxury asset. The real goal of real estate investing, or even smart home ownership, is long-term wealth building, not just showing off. By understanding the dark truth about luxury real estate, you can shift your mindset from consumer to investor. Instead of tying up a disproportionate amount of capital in a single, illiquid asset with high holding costs and limited appreciation potential, you can strategically allocate your resources. This allows you to build a diversified portfolio, generate reliable rental income and cash flow from multiple sources, and benefit from the powerful force of leverage and equity growth across several properties. In liquidity, true financial stability through real assets comes from making informed, data-driven decisions that prioritize fundamentals, market depth, and return on investment, rather than the fleeting allure of expensive finishes. Focus on the engine of wealth, not just the shiny exterior. So the dark truth about luxury real estate isn't that it's inherently bad, but that its perceived value often overshadows its actual investment potential. It's a segment where emotion often overrides logic, leading many to miss out on greater wealth-building opportunities. Your mission, as a smart home buyer or investor, is to look beyond the veneer of granite countertops and expansive views. Ask yourself, does this property align with strong market fundamentals? What is its true liquidity? And what is the opportunity cost of investing here versus in properties that cater to broader, more consistent demand? Make smarter property decisions. Think long-term about real estate, and build wealth strategically by focusing on what truly drives value and returns in the property market. Don't let the glamour blind you to the often superior returns found in less flashy, but far more fundamental real estate investment.